Welcome to Investing Lighthouse, where we explore the world of investing. Today, folks, fasten your seatbelts and put on your thinking caps because we are about to embark on an epic battle of the investing titans. In the red corner, we have the relentless, ever-watchful, and strategic active investing. And in the blue corner, the calm, cool, and collected passive investing. Two contrasting investing styles, each with its legion of followers. Who will emerge victorious? Let's find out! Now, before we dive in, let's understand our contenders. Active investing is like being the Sherlock Holmes of the financial world. It's all about doing meticulous research, making calculated decisions, buying low, selling high, and outsmarting the market. It's akin to navigating a ship through a storm. Hands firmly on the wheel, eyes on the horizon, making decisions on the fly. It's time-intensive and requires a good understanding of the market dynamics. On the other hand, passive investing is more like being a Zen monk. It's about finding inner peace with market trends, buying into broad market indices, and holding on to them for a long time. It's less about steering the ship and more about setting the sails and letting the wind do the work. The goal here isn't to beat the market, but to join it, to mimic its performance. Now, let's delve into the strengths and weaknesses of each strategy. Active investing, being the ambitious strategy it is, holds the potential for above-average returns. It's like treasure hunting, where spotting an undervalued stock can feel like striking gold, and when done right, it can indeed lead to immense profits. Remember the stories of star fund managers like Peter Lynch or the sage of securities Warren Buffett? They have consistently outperformed the market, turning a profit even in the direst circumstances. But active investing isn't for everyone. It's like taming a wild horse. It requires skill, patience, and a significant time investment. And then, there's the cost factor. Active funds often come with high management fees, which can nibble away at your returns, like tiny financial piranhas eager to take a bite out of your investment gains. Also, according to a report by S&P Indices, over a 10-year period, 85% of large-cap fund managers failed to outperform the S&P 500. Ouch! That's a sobering stat for active investing. Now let's turn our attention to the blue corner, passive investing. The Zen master of our investing dojo offers consistency and simplicity. By buying into an index fund or ETF, you're spreading your risk across the entire market. It's like putting your eggs in several baskets, reducing the risk of losing all your money if one company goes under. And here's the cherry on top. Passive investing is cheap, with expense ratios as low as 0.2%. It's a stark contrast to the 1 to 2% fee commonly charged by active funds. That's like going for a buffet and getting a smorgasbord of options for the price of a single dish. But wait, passive investing isn't a bed of roses either. You're essentially tied to the fate of the market. In a downturn, there's no shield. Your investments will take a hit. Moreover, passive investing offers market returns, but it doesn't offer the chance to beat the market. So, who's the winner? Well, it's not as simple as that. Your choice between active and passive investing should depend on your personal goals, risk tolerance, time commitment, and market knowledge. Remember, investing isn't a sprint, it's a marathon. The real victory lies in growing your wealth over time. But whether you're an active investor, hands on the pulse of the market, or a passive investor, riding the waves of the market trend, remember, that the essence of investing lies in understanding your own temperament and financial goals. There's no one-size-fits-all strategy here. The market is a giant buffet, so you must find what suits your palate. But here's a twist. While we've talked about these two strategies as being opposites, they aren't necessarily mutually exclusive, since many investors use a mix of both, like using salt and pepper to season your meal. You might find a blend of active and passive strategies to be the key to your investment success. In the world of active investing, the thrilling chase of finding the next big thing can be intoxicating. And when it pays off, it's like hitting the jackpot. But it also means staying on top of market trends, economic news, and company reports. It's a full-time commitment, and not everyone can or wants to dedicate that much time. Active investing is akin to a thrilling roller coaster ride, with the potential for exhilarating victories and heart-wrenching losses. This can be emotionally stressful for some people. As for passive investing, there's beauty in its simplicity. You have the chance to ride the wave of the market's collective triumph. And over the long run, history shows us that the market tends to rise. But remember, it's a slow and steady strategy. You won't see overnight success, but rather gradual growth over time. Now, let's touch on the subject of fees, a critical aspect of investing that can significantly impact your returns. Active funds, due to their hands-on approach, have higher fees. These fees can take a bite out of your profits, particularly when the fund fails to deliver strong performance. On the other hand, passive funds with their set-it-and-forget-it style have considerably lower fees. This cost-effectiveness is a major selling point for passive investing, as even a few percentage points saved per year can make a world of difference in the total wealth you accumulate over decades. As for historical performance, studies have shown that over the long term, most active fund managers fail to outperform the market, especially after accounting for their higher fees. However, a small percentage of active fund managers, the cream of the crop, do manage to beat the market consistently. It's like finding a needle in a haystack. But if you do find it, it could be golden. The efficiency of the market you are investing in is also an important consideration. Active investing can be beneficial in less efficient markets, where mispriced securities are more common. In highly efficient markets, it's more challenging to consistently outperform the market, making passive investing a more attractive strategy. So folks, the debate between active and passive investing is a long and enduring one, with compelling arguments on both sides. However, ultimately, the decision rests in your hands. Whether you choose to be the captain of your ship, braving the storms and charting your course, or prefer to go with the flow, riding the waves of the market. The ultimate goal is to ensure your financial growth and security. Remember, investing is not just about making money. It's about making smart decisions. So equip yourself with knowledge, understand your risk tolerance, and define your financial goals. Whether you chose the path of the active investor or the passive investor, remember that the journey is as important as the destination. And that's a wrap, folks. This has been your guide to the ultimate showdown, active versus passive investing. Now armed with the knowledge to make informed decisions, go forth and conquer the realm of investing. We're eager to hear your thoughts and feedback, so please feel free to leave your comments in the section below. If you found this video informative and useful, please show us some love by smashing that thumbs up button and subscribing to our channel. Thanks again for watching, and we look forward to seeing you in the next video.